Hello everybody, welcome back to the channel. My name is Maniko and today we're going to be discussing if we are in a stock market bubble. We're going to be looking at a lot of data today. I did a lot of research for this video and let's just get right into it. So first let's look at the S&P 500 year to date. Year to date is down 5.04% as of this screenshot, and it's also up 9.5% in the past year. Looking at the NASDAQ, it's up 6.11% in year to date. It's up over 25% in the past year. That is incredible to think about. If we look at the S&P 500 PE ratio, basically looking at the valuation, it's at a current 22 PE ratio. That's incredibly high. So usually whenever it gets above that 21, 22 range, usually it does come right back down. So as you can see, we're in that top quartile range where it's really dangerous to stay. And surely there'll be something that happens. We don't know when it'll happen, but things definitely can't stay this way. Either earnings have to come up or prices have to come down. Now, if we look at the forward P for the S&P 500, we can see that for the earnings taken into account for the full year of 2020, we stand at a current 21.2 forward P ratio. That's extremely high, and honestly, I don't know how this can be sustained. So if we start looking at the data, let's start looking at the data. 1 in 4 American workers have filed for unemployment during the pandemic. 25% of Americans have filed for unemployment. More than 40 million Americans have filed first-time unemployment benefits. And another 2.1 million filed initial jobless claims last week on a seasonally adjusted basis. So as you can see right now, the total claims over the past 10 weeks is over 40.7 million claims. So the Bureau of Labor Statistics report is coming out on Friday, and they're basically expecting that May's unemployment data is going to be around 20%. The unemployment rate is going to be about 20% for May. That's incredibly high. If we look at something here, we can see that 55% of Americans are invested in the market, okay? Only 55%. Now, that's a little more than half, but that means that half of the population is missing out on these stock market gains. The only people that are really gaining from this are the people in the market. The general economy isn't doing that well, yet the stock market continues to go up. So the only people really benefiting from all this are the people invested in the market. And since only 55% of Americans are invested, that means about half of the population is basically missing out on all these gains. If we look down here, we can see that 84% of all US stocks are owned by the top 10% of Americans. So basically what we're seeing here is that the rich are just going to get richer. And if you can't beat them, join them is what I say. So just start getting invested in the market, because the people that aren't invested in the market, those are the ones that are going to lose out. Although we might be possibly in a bubble, there are always some good deals out there. So you always have to be looking for those deals and always get investing in those good companies that you believe in for the long term. So if we want to see why the rich are getting richer and the poor are only getting poorer, let's take a look at the most owned stocks in Robinhood, which is an app many millennials use to invest, and we can see what millennials are holding the most of. Now, number one is Ford. Okay, over 860,000 people are invested in Ford. I say that Ford is extremely risky. They're losing all kinds of money right now, and their balance sheet is terrible, so that's a terrible investment. GE, terrible investment, terrible balance sheet, and that's more of a turnaround play, but they can both easily go bankrupt. Then we have Disney. Disney is actually an okay company. Then we have American Airlines, an extremely speculative position. Basically, it's the most at risk of defaulting out of all the airlines. We have Delta Airlines. It's in yellow because it's not that bad, but it's still an airline, so it's still speculative. We have GoPro, a terrible investment, obviously. Then we have Aurora. That space is extremely speculative overall. It could be a good growth stock, but as of right now, it's extremely speculative. Then we have Carnival. I do believe they'll make it through this pandemic, but still a speculative position to be at number 8 out of all the stocks in the entire market. Then we have Microsoft, which is an okay company, and then we have Apple at number 10. But if we take a look here, Ford, 860,000 people own Ford, whereas only 380,000 own Apple, which is the largest company in the world. So more than double the amount of people that are invested in Apple are invested in Ford. So that's incredible to look at, and that just gives us an idea of how speculative people are getting in the type of investing they're doing. That's a real indication that a stock market bubble is imminent. Now, if we look here, we can see that central banks' asset purchases is creating a fake market, according to an analyst, and I also believe this. If we look, the Fed has been buying about $2.4 billion in financial assets per hour. $2.4 billion per hour. That's an incredible rate, and this has been going on for the past 8 weeks. Okay, the Fed's balance sheet stands right now at a total of $7 trillion. Okay, it's up about 80%, okay, since early March. These numbers are staggering. Okay, it just shows how hard the Fed is backstopping the entire market. Now, when you have something like this going on, you can see that the market is artificially inflated. If the market was let to do whatever it had to do naturally, that we would be down way further than we are right now. We would be still at the March 23rd lows, if not even lower. So with the Fed backstopping the stock market as it has been doing, it's creating an artificially inflated market. So if we look here, the Fed is actually expected to decrease their buying in the next couple of weeks to about 600 million in financial assets per hour from the 2.4 billion. So that's a 75% decrease. Now, when that happens, we'll really see how the market reacts, because right now I feel as though the Fed is backstopping everything, and as soon as they pull back, the stock market is going to go wild. Now, this is a very important point I saw. The S&P 500 is trading at October 2019 levels, and at that time, U.S. unemployment was sitting at 3%. Okay, 3% versus right now it's over 20%, and there were projections of earnings growth for 2020. Now unemployment sits above 20%, as I just said, and EPS projections call for a 20% decrease. Okay, so let's just look at this right now. The valuations right now in the stock market are the same as October 2019. And now if we compare the unemployment rates, 3% versus 20% right now, if not higher, because usually these unemployment statistics are usually rounded lower rather than upwards, because a lot of people that haven't filed, or for several reasons. So 3% versus 20%, that's already a huge increase. And then we look at the EPS estimates. From growth, at least 5% growth they were expecting for 2020 and 2019, whereas now we're expecting a 20% decrease. And valuations are at the same level. Let's just continue here. So since the beginning of March, the Fed's balance sheet has increased by over 70%. So this is basically creating a huge long-term problem to solve a short-term problem. In the short term, the stock market has gone down, and a lot of people don't like the stock market going down because they see their accounts and their values and their sums of money that they have in their accounts decreasing. Whereas now they're creating an artificially inflated market where their accounts are fine, but the long-term effects that this is going to have on the entire country, on the entire debt of the country, is going to be astounding. I also want to take a look at this graph I found. It's very interesting. It demonstrates the difference between the percentage change of the S&P 500 and the general sentiment in the entire economy. Now, if we look here, usually it's around 10%. Maybe sometimes it gets down to 15%. Sometimes it gets down to negative 20%, but usually that's the extremities. Right now, we're over 30%. Now, what does this mean? Basically, it means that people aren't feeling that confident, yet the market is showing an extreme amount of confidence in the economy. When you have general consumers and the general public not feeling very confident, and the economy not doing very well in general, yet the stock market is up at the levels we saw, there's a very huge disconnect. And when we see a 30% disconnect, where the highest since 1980, since 1980 has been 18% difference. We are at a level where we have never been before in terms of the contrast between the confidence and the valuations in the stock market. Now, you may be asking yourself, how long could this go on for? Despite there being a possible bubble, doesn't mean that it's going to burst anytime soon. If we take a look at the dot-com bubble, it lasted between 1995 and 2000. It only started bursting in 2001, and it took 2 years for it to burst. Between 1995 and 2000, the bubble was building up, and valuations were getting more rich and more rich. And over time, it came to a point where the NASDAQ was up 5 times in 5 years. The entire NASDAQ went up 5x in 5 years. An entire index going up 5x in 5 years is extremely dangerous. And that was definitely a bubble, and it took 5 years for it to burst. So you might be asking yourself, what's the point of this video? Although the market can be an extraordinary place to invest over the long term, you always need to take a look at valuations and never get caught up into the fact that stock prices are going up and that's why you invest in them. Always invest because the fundamentals are in place and because you believe in the companies long term. There's a saying I really enjoy in the stock market, and it's something to live by actually. And it says the stock market can remain irrational longer than you can remain solvent, meaning never bet against the market. That's not the way to navigate situations like this, because they can last for a very long time, as we saw with the .com example. What you want to do is just always take a look at the fundamentals of businesses and always invest based on fundamentals, and you'll do fine over time. Never get caught up into the trap that because stock prices are going up, they are good investments, because that's not how the stock market works. Just focus on the long term and you'll do very well in this market. But apart from that, guys, hope you guys enjoyed. If you did enjoy, don't forget to leave a like and subscribe down below. Also click the notification bell so YouTube notifies you when I post new videos. And you can also follow me on Snapchat at Domenico Marti YT for notifications on when I post new videos. But apart from that, until next time, have a great day.